Welcome back for the 20th episode of CBA's Talking Economics with the Commonwealth Bank of Australia's Chief Economist, Stephen Halmarick. Stephen, thanks for joining us. The RBA has kept the cash rate steady at 4.35%, but there is a view they may have changed their outlook on the direction of rates. What do you think?
Yes, as you said, they kept the cash rate steady at 4.35%. That was widely expected by us and the markets. But in terms of the bias they have on monetary policy, previously they were saying that another interest rate increase could not be ruled out. They've removed that sentence and now saying they can't rule out anything, up or down or unchanged. So you might call that a neutral outlook. But that's consistent with our view that there's no more interest rate increases in this cycle, and the Reserve Bank can look to start lowering interest rates from September this year.
OK, the recent labour market data and the CPI surprised the market. What's your view on that?
You're right. The labour force numbers and the inflation numbers surprised the market, but in opposite directions, if I can put it that way. So the February employment numbers were much stronger than expected. Employment increased by 116,000 in the month of February, and the unemployment rate moved from 4.1% back down to 3.7%. So a really strong employment report. We will get another employment report for March before the next Reserve Bank board meeting, so we're watching to see whether there's a bit of a payback from that surprising strength in February. On inflation, we had the opposite. So the February inflation number came in lower than expected at 3.4%. The market was expecting 3.5%. It's now been steady at 3.4% for December, January and February, so really good sign that inflation is continuing to decelerate, and that's consistent with our view that the Reserve Bank can start thinking about lowering interest rates later this year.
And your thoughts on the last CommBank Household Spending Insights report?
So the HSI for February showed a small decline in spending, down 0.3% on the month. And we could see that 7 of the 12 spending categories actually weakened. There was some strength, particularly in hospitality and recreation, around the big events that are happening over the summer months. But if we look at the last 3 or 4 months as a whole over summer, lots of volatility, but spending was lower in February than it was back in November last year. So overall, the HSI is supporting the view that consumer spending is very soft. We think that's going to continue over the next few months, and again, that's consistent with the slowdown in the economy from the higher interest rates the Reserve Bank has put in place.
And Stephen, as we head into the last quarter of the financial year, what data should business be focused on?
We will get another monthly round of the inflation and employment numbers towards the end of April, so there'll be certainly a highlight or a focus for the market. Early May, we get the next Reserve Bank board meeting. We'd be expecting the Reserve Bank to keep interest rates on hold again and keep that neutral outlook for interest rates in place. And then on the 14th of May is the budget, the Commonwealth Government budget for financial year 2025. So we know the 2024 budget looks like it's going to be in a small surplus, and we in the market would be looking for the government to continue with some fiscal discipline to make sure fiscal policy is not adding to the inflationary pressures in the economy.
Well, great to get to your thoughts, Stephen. Thanks for your time.
My pleasure. Thank you.